In this video, we'll explore the fascinating world of corporate actions, specifically focusing on stock splits, share consolidation, mergers, and demergers. Let us begin with a concept known as a stock split. Imagine you have a large pizza that is cut into 4 slices. If you cut those slices again to make 8 slices, you do not have more pizza, you just have more pieces of the same pizza. A stock split works in a similar way. It is a corporate action where the company reduces the face value of its existing shares. For example, if the split ratio is 1:5, the face value of your share reduces to 1/5 of what it was. Consequently, the number of shares you hold increases by 5 times. From the company's perspective, the total share capital remains exactly the same because the increase in the number of shares is perfectly balanced by the drop in face value. You might ask, why would a company bother to do this if the value stays the same? The main rationale is about affordability. Sometimes the price of a single share in the stock market becomes very high, making it difficult for small investors to buy even one share. By splitting the stock, the price per share comes down, making it affordable for more people to buy and sell. However, you must understand the reality. This is purely a book entry. There is no direct economic benefit or extra money given to you. It is largely psychological, making the stock feel cheaper, which might increase trading activity. But your proportionate ownership in the company remains unchanged. To make this crystal clear, let us look at a real-life case study of the State Bank of India or SEBI. In this case, the bank had a face value of rupees 10. The market price was trading around rupees 2,700. They decided to split the stock, so the face value became rupee 1. This means if you held 1 share, you suddenly held 10 shares. Correspondingly, the market price adjusted from roughly rupees 2,700 down to about rupees 295. If you do the math, your total value before the split was rupees 2,700 and after the split it was roughly rupees 2,950. The value remains roughly equivalent, subject to market demand. Now we will look at the exact opposite of a split, which is called share consolidation. Here, the company decides to combine multiple shares into one. This increases the par value of the shares. If you look at a consolidation ratio of 5:1, it means 5 of your existing shares are combined to form just one single share. Mathematically, the face value goes up 5 times and the number of shares you hold drops to 1/5 of the original number. Why would a company do this reverse action? Usually it is because their share price has fallen very low in the market. When a stock price is too low, investors might perceive it as a low quality or penny stock. By consolidating shares, the price per share jumps up immediately. This can improve the market's perception of the company's prospects. Just like the split, the financial impact is neutral. It is a book entry. The earnings per share and book value will look like they have improved instantly, but since you hold fewer shares, your overall position hasn't actually changed. Let's calculate this with a scenario to prove the neutrality. Imagine you hold 500 shares of a company and the current price is rupees 5. Your total investment value is rupees 2,500. Now, the company announces a consolidation ratio of 5:1. Your 500 shares will become 100 shares. To keep the value fair, the price should mathematically jump 5 times to rupees 25. If you multiply your new 100 shares by the new price of rupees 25, you still have a total value of rupees 2,500. So the market value is preserved. Moving on to a more drastic change, let us explore mergers and acquisitions. These are actions that fundamentally change who owns the company. We often group these terms, but they are different. A merger is when two companies, say company A and company B, combine. Company B is absorbed and ceases to exist, leaving only company A. An acquisition is different. Here, company A buys the stock of company B, but both companies typically continue to exist. Then we have a consolidation where company A and company B join together to form a brand new entity, company C, and the original two companies cease to exist. What drives companies to take such big steps? There are four main motives. First is synergy. This is the idea that two companies work better together than apart, perhaps by combining factories or technologies to lower costs. Second is growth. If a company wants to increase its revenue or market share quickly, buying a competitor is faster than building from scratch. Third is diversification. A company might buy another business to enter a new country or a new product line to gain a competitive advantage. Finally, there is taxation. Sometimes a profitable company will buy a loss-making company just to use those losses to reduce their own tax bill. Because these changes are so significant, there is a strict regulatory framework. In India, SEBI has a set of rules from 1997 known as the Takeover regulations. These rules are there to protect you. If an acquirer buys a large chunk of shares and gains voting rights, it triggers certain requirements. The most important one is public interest. The regulations often require the acquirer to make an offer to the public shareholders. That is, giving you an opportunity to sell your shares and exit the company if you do not like the new ownership. Finally, we will look at what happens when a company wants to become smaller or more focused. This is called a demerger or spin-off. This occurs when a parent company carves out one of its businesses into a separate independent company. If you are a shareholder of the parent company on the record date, you are eligible to receive shares in this new company for free. The ratio is decided based on the value of the business being separated. A classic example of this can be seen with Adani Enterprises. In April 2018, they spun off their renewable energy business into a new company called Adani Green Energy Limited. Shareholders received new shares in a ratio of 761:1000. This wasn't the first time. Earlier, in June 2015, the same parent company spun off two other huge businesses, Adani Ports and Adani Transmission. In each case, the parent company became lighter and shareholders found themselves owning shares in multiple specialized companies instead of just one giant conglomerate.